Well, happy weekend to you. This is the Real Money Pros. And yes, that's what we're here to do. We're here to make confusing financial topics simple. Because if there's one thing the financial advisor industry does, and they certainly get a bad rap for this, is making you think that all these things are so complicated and you need some secret decoder pin, then that's how you need to understand it. So you must hire that said person so then you can get to your goals. That's not necessarily the case. A lot of times it's just you need the education, might need some analogies, you might need some visualization, some theater of mind, if you will, for it to make sense. But also you probably have specific questions that apply for your specific situation. I mean, there is that thought process around the strategy and the inner workings of this financial concept and this and that. But then you have that, you got to bridge that to, okay, what does that mean for me? I'm married, I got my kids, I want to retire, here's how much I make, here's the things that I want to do, and here's my quality of life. How do you bring that together? Well, that's what we are here to do for you today and every weekend for that matter. I'm Jeremiah Bates. He is Nick Daniels. We are Fiduciary Financial Advisors, and we are live. A lot of great financial programs out there over the weekend. What sets us apart is you can interact with us live, whether you want to call the program or you want to send us a text message or you want to send us an email. Fair game. Send it our way. If you give us the authorization, we'll answer that question online, workshop it through, and hopefully give you and the greater audience more education, some more things to ponder on that really just puts everyone in a better position at the end of the day. That's what we're here to do. We're not here to sell anything. We're here to guide, give advice, provide education. That's it. We are a sponsor-driven program, period, end of story. Phone lines are open, 979-59-MONEY. That is 979-596-6639. You can text that number as well. Send us an email, jeremiah@therealmoneypros.com. Nick, that's NIC, @therealmoneypros.com. Like I said, any comments, questions, send them our way. Nick, obviously a historic event that took place on Friday, and that's SpaceX, the company that is the brainchild of Elon Musk with all these different ventures. When you talk about space exploration, reusable rockets, trying to make the human species multiplanetary. You'd have the Starlink satellites that provide broadband internet, basically anywhere that you have a unobstructed view of the sky. You also have, what's the other one in there? You have, and their AI company as well. XAI. So obviously a lot of hype, a lot of enthusiasm, a lot of headlines that was leading up to this public offering. And just real quick, this IPO, just a fancy way to say that the SpaceX was previously a private company, meaning you could not go to your Fidelity account, your Schwab account, and have ownership of SpaceX, but now you can. And that took place on June 12th. And that IPO, tough to say if it beat expectations. I think there were some expectations that it would open up and start trading lower than actually what its IPO price was, which is $135. But correct. I think at the end of the day, it wasn't really volatile. I feel like it had some pretty quick price discovery, at least for that first trading day. I think it finished up around 19-20% to end the day. Yeah, right at 19%. Again, the IPO price was supposed to be $135. Right at opening, it shot to $150. Throughout the day, it hit a peak of $176.52 a share. And then settled in to close at $160.95 a share. So right at a 19% gain on its first day. And in after hours trading, it's still a little bit above closing price, but not a huge swing in price action after hours. They raised $75 billion on June 12th, on Friday. So that makes it the largest initial public offering in history, giving SpaceX a market cap of $2.1 trillion with a T, $2.1 trillion. That is crazy. That is absolutely crazy. Well, I think it's when you start getting into the numbers of billions and trillions, it's just really hard for the human mind to put something tangible compared to that. What's wild is like the time of which it would take you to get somewhere if it was like 100 miles, 1,000 miles, 1,000,000 miles, 1,000,000,000 miles, and 1,000,000,000,000 miles. It's just it's mind-boggling. It's like, how does that even happen? But this is where we are. This is the state of the markets. This is the state of these private companies. And keep in mind, there's still a couple coming down the horizon that might not have as much hype, and they're working behind the scenes filing some initial interest or confidential IPOs with the SEC. But you have OpenAI, which is the company that was the creator of ChatGPT. Lots of retail users. You have Anthropic, which they have their large language model Claude, and a lot of retail users. These companies are going to be doing their IPOs to the likes of the trillions as well. I think the initial estimated value of SpaceX, OpenAI, and Anthropic, I think it was between $3.5 and $4 trillion with a T. And this just speaks to this narrative that's been driving the markets over the past few years, and it's this hype and enthusiasm around AI. And I use that word hype cautiously because I think generally speaking that the terminology of hype means that it's not necessarily justified. It's like irrational exuberance. Like, does it live up to the hype? But you could argue that that's where things are going. I do think that there's some companies very similar to the dot-com bubble that might be a part of some froth that may have a high valuation that didn't have that justification. But I think if you look at AI in a vacuum on its own, as far as the technology and the mass investment and how this is going to be used, I think it's here to stay.
Yeah, something I was reading about this IPO for SpaceX, and I thought it was interesting. They were comparing a few of the details of SpaceX as a company going public versus Tesla, when Tesla went public, right? And they were saying, okay, at the time, Tesla was only a car company. And you could argue that Tesla was more of like a battery company at the time, but that was their product, was the cars that they were launching. And that was it. They were at the forefront of electric vehicles. It was definitely a niche, and nobody was quite sure of what's going to happen with Tesla if these electric vehicles aren't adopted, yada, yada, yada. One of the differences they were saying with SpaceX is SpaceX actually has about 3 different you could say product offerings that they're working on that are either developed or in development. You already covered the reusable rockets, right? And SpaceX as a company is launching not just their own not just their own satellites. I mean, they are the number one provider for getting anyone's satellite into space. So they have that business vein. When you talk about XAI and where they're talking about trying to get putting compute power in outer space, because then you don't have the energy demand to cool those servers, keep them cold. That's an avenue of business. And then developing the AI itself, the large language models. There's this Grok.
Mm-hmm.
I always want to say Gronk, like the football player, but Grok. But, so they've kind of got 3 potential streams of business revenue that they're looking at. And they were just saying, basically, the article was saying it appears to be more of a positive trend, positive trajectory for your initial purchase of SpaceX stock, now that it's public, to see growth that we all want to see, the growth that's up and to the right.
Well, I think also looking at SpaceX, it's a question that is reasonable for a lot of individuals is, should I invest in it? And that's a great question. I mean, if you have that top of mind, if you've been thinking about it, if you're like, dang it, I was not in front of a computer, or it totally slipped my mind to purchase SpaceX on Friday and it finished up 20%, dang it. Well, I'm going to buy some when the market opens on Monday. If you have that top of mind, please call us, because we'd love to walk through, is this a good idea or not? Because interesting statistics. So this was IPO, essentially a gentleman by the name of Jay Ritter out of the University of Florida. He did some analysis on IPO data, initial public offerings, and across more than 9,000 operating company IPOs. Okay, so basically you had 9,000 companies that filed IPOs going back from 1975 going to 2021. 60% of those companies finished flat, meaning no growth on their stock price, or lower 3 years after their first close. Only 16% more than doubled. So if you're looking at the historical reference points around IPOs, now could you argue this is different? Perhaps. You look at the technology, you look at the leadership. It's a little bit different than what we've seen of who was at the helm, and obviously access to information back to 1975, even back to the 2010s.
Oh, no kidding.
The probabilities of SpaceX based on those numbers, not too high. So the question becomes, why do you want to own it, and what's your strategy? We'll be right back. We are back. I'm Jeremiah Bates. He is Nick Daniels, Fiduciary Financial Advisors, here for you. Visit therealmoneypros.com. It's where you can get access to our previous podcasts, our educational content that we do try to update on a weekly basis. And we cover lots of topics every Saturday or every week through our podcast. And if there's one thing that becomes pretty clear, and obviously this became very clear to myself, and this is probably came clear to you, Nick, working with probably thousands of households combined between the two of us, and especially in our office. Good financial decisions do not happen by accident. You're probably trying to navigate retirement, navigate tax efficiencies, business decisions, or you just want more clarity around your financial future. Having the right guidance matters. If you'd like to get connected with a fiduciary advisor who can help you navigate these waters, visit therealmoneypros.com, click on the Find an Advisor tab, and we'll connect you with an Apollon Wealth Management fiduciary advisor who is a good fit for your situation. You've probably been thinking about doing this, doing that. Time to start taking some action. Ideas are great, but where they fall apart is either bad execution or lack of execution. So that's the idea here, trying to spur some action. And again, that's therealmoneypros.com. Click on the Find an Advisor tab. Also, we're live. You have questions, call us, send us a text message, 979-59-MONEY. That's 979-596-6639. Okay, wild statistic when we're talking about SpaceX, and now it's market capitalization. So for market capitalization, because you'll hear this a lot of times in headlines of, the first $1 trillion company here, and its market cap is now worth over $1 trillion. You take the amount of stocks that are out there for this company that's eligible to be traded, multiply that by the stock price, you get the market capitalization, aka the value of that company. So we're looking at SpaceX. Yeah, what was it? What did you say? Two and a half?
$2.11 trillion market cap.
So just to give some perspective on this, if we were looking at a million and a billion and a trillion, comparing the two, trying to put something tangible towards it, 1 million seconds ago was last week. 1 billion seconds ago, the internet was barely a thing. 1 trillion seconds ago, Neanderthals were still walking the earth and the humans were in the Stone Age. So it just boggles the mind of when you enter into this territory, but here is where we are. Now, I think an important thing to know about SpaceX is, obviously we put it out there, and that question's still out there if you want to call the program. Are you excited about SpaceX? Do you think its initial gain in the market when it became publicly traded on Friday, was that justified? Do you think that stock will continue to go up and to the right? Or are you negative on SpaceX, meaning you wouldn't touch it with a 10-foot pole? But I think it's important to also touch on the fact that if you are doing what you would know as passive investing or index investing, which
Correct.
To be clear is no argument from me there, where you can buy broader markets. You don't need to be as selective to try to pick your winners. You get diversification and you get representation through hopefully the U.S. market, international markets. You can get in different sector and different asset classes, meaning large companies, your small caps, your mid caps, your large caps, your bottle caps, you name it. You can get access to it through these passive investing vehicles. So with SpaceX, there is going to be some changes, not necessarily changes, but some inclusion for a lot of these passive investors, even if they want SpaceX or not.
Yeah, so I'll springboard on that. Remember, prior to their IPO, the NASDAQ 100, ticker symbol QQQ, they revised their rules on what it takes to be included, actually to facilitate the SpaceX IPO. And so what you will see is if you own QQQ, again, that NASDAQ 100 index fund, you are probably going to be a partial owner now of shares of SpaceX in as little as 15 days. So realistically, we're looking at late June, early July. If you own that passive index fund, you've got SpaceX. There is Vanguard. Vanguard licenses these CRISP funds, which CRISP, C-R-S-P. Now that stands for, where is it right here? The Center for Research in Security Prices. That's based out of the University of Chicago Booth School of Business. It's a rules-based formula on what to include. It's automatic, based on their standards, again, which Vanguard exclusively licenses that. If you own the following ETFs, the Vanguard Total Stock Market Index, if you own the Vanguard Growth ETF, or in your retirement plan, if you have the Vanguard, the mutual fund, the ticker symbol VTSAX, which mirrors up with the ETF VTI, the Total Stock Market Index, those three funds, you are going to now have exposure to SpaceX within 5 business days. So don't feel like you missed out on the IPO. You're going to own SpaceX within 5 days. Now, the S&P 500 is a different dog.
Well, yeah, I think it's important to note how these index operates, because if you are participating in your employer's 401k, what you probably see when you set that up, or if you're making investment changes, is they have a fund lineup. You know, there might be maybe 10 to 20 different options in there. A lot of times they have what's called target date funds. So it'll say like, you know, target date fund 2060. And what that means is that as you get closer to 2060, that investment, that vehicle is just going to get more conservative. So if you look at the actual holdings within that fund, you know, if you're 30 years away, you're going to be more equity based, right?
Correct.
Less fixed income, less cash. But as you get closer to 2060, that'll get more conservative. Sometimes it makes sense. Sometimes it doesn't. Take that with an asterisk. I'm not the biggest fan of target date funds generally, especially for someone who's 30, 20, or even 10 years out from retirement. Those things might be a little bit too conservative. Just a little side note. But bottom line is you'll likely have a lineup of those types of options in your 401k. And then you're likely going to have an S&P 500 fund, like a mid-cap fund, a small cap, some international. So most of investors, especially doing it through the 401k space, you're inherently investing in these passive indexes. And so how do they arrive at it? Let's take the S&P 500. The S&P 500, Standard & Poor's is the company that basically creates that list. So if you go buy, let's say, SPY or IVV, these are ticker symbols of S&P 500 ETFs, meaning if you took $1,000 and invested it in one of those ETFs, it's going to track what the S&P 500 does. So if the S&P 500 is up, then that ETF, if the S&P 500 is up 5%, then that ETF should be up 5%, maybe slightly less at the end of the year, because they usually charge a negligible fee of like 0.03%, if you will. So there might be a slight disconnect there, but not much, negligible at the end of the day. So how do you? So the next actual question could be, okay, well, how does Standard & Poor's, like what companies actually are in the S&P 500? It's based on the rules and criteria that Standard & Poor's sets, and they have their own rules-based process that allows a company to be included into the S&P 500 or removed from the S&P 500. And it's the same thing with the Dow Jones, it's the same thing with the NASDAQ 100, it's the same thing with these other indexes that are published. I mean, it's basically just a running list. Well, that list needs to have some rules of who's going to go in and who's going to go out. So I know there was some rumors that the S&P 500 was going to make some exceptions for SpaceX. Not the case. They got to show 4 quarters of basically profitability. They got to be of a certain size, a certain trading amount. And reality is, SpaceX, based on their initial financials, they don't meet the profitability side of things. Could they get there? We'll see. Might take some time. Real Money Pros will be right back. Welcome back to the Real Money Pros. Again, phone lines are open, 979-59-MONEY. Give us a call. Send us a text message. That is 979-596-6639. Okay, I think that rocket ship has sailed on SpaceX. Applause to Elon Musk for his successful IPO debut
and becoming the world's first trillionaire.
Good for Elon. I'm just joking around. It's just who knows? But hey, a lot of people refer to him as the Howard Hughes of our generation, right? And I think if someone wants to push the level of humanity forward with multi-planetary explanation and being able to inhabit a different planet, it's kind of wild, but that doesn't necessarily translate to a good investment. But clearly, if how it's working out so far, so good. Whether this will continue, like I said, I think it'll probably take a little bit of time, at least from a fundamental standpoint, for SpaceX to actually show, positive flow, like good, solid profitability. But that doesn't necessarily mean that the stock price, there can be a disconnect between those two.
Correct.
Meaning a company does not
Correct.
necessarily have to be profitable to see that stock price going up and to the right, because the stock market is a discounting mechanism, meaning it's forward-looking. It's pricing that company based on what it's going to produce in the future, and that cycle just perpetuates itself. So, again, let's pivot from that, and I want to talk about taxes and an event or a date or a deadline, if you will, that's going to take place at the end of this year that may have been off the radar for many individuals who went ahead and put themselves in this type of investment known as a qualified opportunity zone.
Yeah,
a QOZ.
These QOZs. Jeremiah, to remind our listeners, where did these come from? Well, the qualified opportunity zones were created back in 2017 in President Trump's first term under the Tax Cuts and Jobs Act. And the whole idea was to take areas that had, think of like areas in cities, municipalities that had been neglected, or industrial areas that were ready to be developed, things like this, kind of air quotes like shovel-ready projects, so to speak, right? But it was designed to say, hey, how can we incentivize investors to pour dollars into these projects so that we can revitalize communities? And on that point, qualified opportunity zones have revitalized many cities and regions. Back in February, I was in Vancouver, Washington, and their waterfront area in downtown Vancouver, beautiful, awesome, full of like fine dining, cool coffee shops, like just nice walking paths and bridges and everything right there along the Columbia River. That was a qualified opportunity zone, where prior to 2017, it was abysmal, run down. You didn't want to go down and hang out there. Now you do, because of this qualified opportunity zone. It pulled in dollars to invest and revitalize. Now, here's the kicker on these QOZs, right? The whole idea was, let's say you have a business that you wanted to sell, piece of highly appreciated real estate that you wanted to sell, and you were going to have this huge taxable gain. Let's just say $1 million in taxable gains that you were going to have to pay long-term cap gains taxes, so 15 or 20%, right, in all likelihood. It was said, hey, you roll those gains, you roll that $1 million into this qualified opportunity zone, you get to defer, not like eliminate altogether.
Keynote
Let's be
there,
clear.
defer.
You get to defer the long-term capital gains tax on that $1 million. And if you keep your investment in that qualified opportunity zone for 10 years or longer, the appreciation on that $1 million investment will not be taxable either. And that was really, really great. Doesn't that sound nice? I have 10 years to wait before I have to pay my long-term capital gains tax on that $1 million profit. And if I keep it in beyond 10 years, if that $1 million has turned into 1.5, I can pull my 1.5 out, and that whole part comes out tax-free. Sounds really nice. Again, it worked as far as pulling in funds to revitalize so many areas and so many communities. But the devil's in the details. We're running up on the end of that 10-year period. And Jeremiah, what is this looking like for people who poured their gains, 1031 exchange their gains, or just put in new cash? Well, no, it's really on the 1031, sorry. But poured in these gains into qualified opportunity zones.
Well, there's a deadline. So again, this is part of the Tax Cuts and Jobs Act of 2017. So when these qualified opportunity zones or QOZ funds became available, anyone who got into these, they had this deadline looming that shows that December 31, 2026, Nick, in your example, that $1 million gain that was rolled into that QOZ, it's deferred until that date. So what does this look like logistically? It means that your tax documents will show that in December 31, 2026, you're going to recognize that capital gain that you deferred from whatever year prior. So let's imagine 2023. you sold the business and you deferred those gains into that qualified opportunity zone, then great. You didn't recognize that capital gain in that year, deferred it out, and 2 years seems like a lifetime ago, all right? Or 3 years seems like a lifetime ago. But now it's important to understand this because we got a lot of runway so far this year to understand that if you are part of that qualified opportunity zone, you can start putting some things in place to help mitigate that potential tax bogey. Because, I mean, if it was a gain of close to $1 million, who knows? Maybe your income changed. Maybe you're making more. So now you got to look at, okay, what is some low-hanging tax fruit that I can take advantage of? And maybe there's some great deferral there. Maybe it's a little bit limited. Bottom line is at least you can be prepared to come up with a liquidity event. Now, I do know that not all of these qualified opportunity funds are cut the same, right? There's going to be a lot of different options out there. There's a lot of these qualified opportunity zones across the country that are eligible, meaning there's lots of qualified opportunity zone funds available, a lot of fund sponsors available. So we're painting with broad brushstrokes here, but a big part of this was that there'd be refinancing within these funds. Like if there was debt that the fund was actually using to operate on, that could in turn result in a liquidity event, which would provide you liquidity to help cover that said tax bogey that would be due when you file your 2026 taxes. So you're looking early 2027, standard tax operating procedure. Bottom line is, if you participated in a qualified opportunity zone per the Tax Cuts and Jobs Act of 2017, start meeting with your tax professional, start meeting with your advisor, bring this up to them and say, hey, got a little reminder that taxable gain that we deferred, good chance it's going to come due December 31st, 2026, meaning 2026, I'm going to recognize a large capital gain. What is it going to be? How much did we defer? What should we be doing basically now up until the end of the year to help mitigate that? But first, uncover what it is. Find out what it is, and then look at, okay, what options are available so you can start getting some planning put in place. Because there are some planning opportunities that can take place before the deadline, whether that's a donor advised fund, maybe if it's a charitable contribution, maybe you still have earned income and you can defer money on a pre-tax basis. Maybe you have some losses that you can recognize from some other type of investment that you can sell, recognize the loss to offset that tax bogey. Maybe there's some other types of investments that you can defer money into. But the key thing to note here is that depending on what timeline you got into that qualified opportunity zone or that qualified opportunity fund, you still might not be able to access the liquidity into it.
Yeah, and one of the things that while this was all going on, like back in 2017, 2018, after the creation of these things, as we were reminding people, hey, these qualified opportunity zones, they're illiquid, meaning once you put your money in, you're not likely to be getting it back out, because essentially think of this, most of them were some sort of construction project, building, revitalizing downtown areas, things like that. So your money was illiquid, and you weren't getting any sort of passive income flow from those either, right? It's not like you were buying a 7-story apartment complex and now you're collecting rent from all of those tenants while you're in this qualified opportunity zone. They were mainly construction projects. So you weren't even seeing cash flow coming in from this. They were illiquid, and you could have to come up with $150,000, $200,000 potentially to cover that tax bogey. One thing you want to ask your tax professional if you're in a qualified opportunity zone, hey, should I consider making a 2026 fourth quarter estimated tax payment in the month of January so I don't run into any penalties for underpayment? Or
looking at the safe harbor rules around withholding. So maybe you don't want to come up with that liquidity event right away because you might have to sell some highly appreciated stock and you don't want to do that in 2026. Well, maybe look at doing the safe harbor rule, which is based on your previous year's income. So you just pay that amount. So even if there's a large under withholding, at least you're not penalized for not coming up with those payments you would do. Because again, if you're looking at a large taxable gain that you weren't expecting, that could cause a lot of surprises, and surprises from taxes generally are not good. A few more things we got to cover on these qualified opportunity zones and make sure you don't run into a tax bogey. We'll be right back. Welcome back. This is The Real Money Pros. Again, therealmoneypros.com is where you can find us. We are live. Phone lines are open. We're in the first hour of a 3-hour live program broadcasting across the country. So I know some markets will pick us up for the first hour. Some will pick us up for the first 2. Some might pick us up for the full 3. So again, if you've missed any part or if different program starts at the top of the hour, again, go to therealmoneypros.com. You can catch the topics that we are talking about. Again, 979-59-MONEY. That is 979-596-6639. Call us, send us a text message as well. You have questions, we'll get you an answer. These qualified opportunity zones, if you were invested in those, if you put money into this alternative asset, again, your main takeaway from the last segment that we were talking about is like December 31st, 2026, that capital gain that you deferred in whatever year that you got into this opportunity zone, you're going to recognize it this year. And it's going to act as if that you recognized it December 31st, 2026, which means that when you are gathering all your tax documents and doing your tax filing, in those first 3 to 4 months, the first quarter of 2027, that's going to be a part of it. So just make sure that you're taking that into your protocol and again, we have plenty of time this year to figure out what options do you have available. We're going to go back to the phone lines right now. Again, 979-59-MONEY. That's 979-596-6639. We have Thomas on the line. Thomas, what can we do for you?
Hey, Thomas, or Jeremiah. Sorry, I almost called you my own name. I was listening to you on the radio here. So I just had a quick question on the QOZs because it's something that I've heard of, and it's actually not pertained to me, but I feel like it's timely because I got a good friend who has been working at Micron for a while. Obviously, you guys are up to tune about what's happening over there with the stock. I was just wondering if QOZs are something you can defer gains into with appreciated stock. I mean, and in this case, Micron. And I'm not sure about my friend's exact gains, but I can assume from how long he's been getting these RSUs that he's probably sitting on quite a bit.
Great question, and the answer is yes. Now there's some differences to this because what we're talking about is the QOZ rules that were per the Tax Cuts and Jobs Act of 2017. Now, the big, beautiful bill per this administration, they've done, I don't know if you want to call them enhancements, but they've done some changes on QOZ rules going into 2027 and beyond. So essentially what this means is he wouldn't actually take those shares of Micron or any highly appreciated stock and put it to the fund. Essentially how that would take place is if he sold Micron, meaning if he sold those shares of Micron, obviously that's going to result in a taxable gain. Now, per QOZ rules, you have 180 days to then roll that gain. So let's imagine he sold some shares of Micron. His capital gain on paper after recognizing that sell, let's just say it's $500,000. Like that's the actual taxable gain that resulted from that sell. He would have 180 days to identify qualified opportunity zones, qualified opportunity funds, roll that gain of $500,000 into those qualified opportunity zone funds, and then he would not have to pay taxes in 2026, assuming that he did it, or if he did it in 2027, he would defer those taxes out in following the structure in what's aligned with the qualified opportunity zones. And I do know per the big, beautiful bill, they have a different categorization of these qualified opportunity zones. If my memory might be mistaking to me, but I think if you defer that gain into, I think if it's a qualified opportunity zone around farming, if I'm not mistaken, then you actually see an enhanced tax benefit. I'll confirm that whether that's right or wrong. But to answer your question directly, absolutely. Whether it's a capital gain across the board, whether it's a piece of property that's sold, whether that's a stock that's sold. But the question becomes, and this is where the tax tail can only wag the dog so much, and Nick, you can add in here, but if he rolls that money into a qualified opportunity zone, the key thing to be aware of, tax deferral is great, and the tax savings is great, but it's illiquid, meaning you're taking that liquid money that you have and you're deferring that into an illiquid investment. Sometimes that makes a lot of sense. Sometimes it's not. So anytime that we're reviewing this alternative investment landscape, it's always important to know, okay, what is the liquidity needs or the liquidity forecast on the horizon, so we're just not letting tax savings govern every decision that we make. Because imagine you defer into a qualified opportunity zone, and then 2 years later, he's like, I need some money because I want to go do this and that. And it's like, well, like Nick's point with these qualified opportunity zones, these are projects, meaning it's like any real estate investment endeavor. Like if you were to invest in that, you can't just sell it halfway through to try and get a liquidity event, especially when you're pooling money together. So I know a long-winded response, but I want to make sure that all the dynamics are covered of a QOZ. If you have a capital gain, whether from selling stock, in this case Micron, certainly can roll that capital gain to a QOZ.
Something else you could consider in a scenario like this, where you have highly appreciated stock, you're charitably minded, and you're saying, is there a way that I can take this asset, this highly appreciated stock, and we'll pick on Micron, and somehow use it to offset the taxes that are coming due from this qualified opportunity zone? You may want to consider a donor-advised fund, because in donating that highly appreciated stock to a donor-advised fund, you're going to get a deduction and
avoid the capital gain.
That would offset the capital gains tax. But again, there's so many nuances to consider in that. Do you still need liquidity? Are you going to need some sort of passive income? So it's not it's just an idea that for some people out there, again, who are charitably minded and looking for ways to, especially like if you don't have the liquidity to cover this upcoming tax bogey from rolling your gains into the QOZ, but you have another asset that you're willing to donate, you could offset those.
Yeah. Thomas, does that answer your question?
Yeah, that was perfect. I mean, I think what I got from that, the main thing to consider was just the liquidity, and, if you needed access to that money, I think that's probably the biggest piece that you'll have to analyze. But no, that makes sense. I appreciate it. I just wanted to make sure that was even an option, because it kind of perked my ears. I've heard this every now and again and just wasn't quite sure.
Well, thanks for calling the program, Thomas. Certainly appreciate it. Again, phone lines are open, 979-59-MONEY. That is 979-596-6639. I want to talk about donor advised funds in the next hour because we're running out of time, because it's an important thing to analyze. Because, Nick, like you brought up, if he was to take those shares of Micron and actually put them into a donor advised fund. And to be clear, a donor advised fund is just a fancy way to say it's an account. Like literally that's what it is.
Yeah.
It is an account that is under the umbrella of a donor advised fund. So I know that's kind of a fancy way to say, like when you hear the word fund, it's like, oh man, probably sounds complicated, a lot of like legal paperwork. There's really not.
It's just an account title.
It's just an account title. Just like if you went to Charles Schwab and opened up an IRA, there's rules around how much you can put in the IRA, what the tax consequences are taking money out. Same thing with a Roth. Very similar to a donor-advised fund. I know Charles Schwab offers these. I think Fidelity does too. And I'm sure there's many other custodians. Those are just the two ones that come top of mind. And obviously with Schwab, the main custodian that we use, pretty well familiar with it. So if you want to set up this donor-advised fund, you set it up. You can invest money inside of the donor-advised fund. I mean, it's just an account. But if you had highly appreciated shares of Micron, or fast forward the clock and SpaceX is up 1,000x, and you say, you know what, I'm sitting on a level of liquidity and net worth that I want to start doing some charitable endeavors. Great, you already have that desired outcome, so let's just make it tax efficient, altruistically. Let's just take that shares of Micron, put them in the donor advised fund. It's liquidated, no taxable event in doing that liquidation. And then you also get that deduction because essentially you're putting money into a charity. Now, it's not going directly to a charity. It's going to the donor advised fund. But how that looks on your tax return, it's the same. Now, there's some rules and some things that I don't say rules, but there's some interesting numbers that I was looking at of, well, does it make sense? Like, what would make more sense? Sell the stock, recognize the capital gain, and then take the cash and put it in the donor advised fund? Or does it make sense to take the stock, transfer in the donor advised fund, and then sell? True, you avoid the capital gain, but does it make sense to recognize the capital gain, use the cash into the donor advised fund, because that deduction that you get is moves the needle as far as the net taxes you would pay? Something that we can analyze, and we'll talk about at the top of next hour. Again, we are here. We are live, 979-59-MONEY. That's 979-596-6639. And we are back. This is hour 2 of our 3-hour live program. We are the Real Money Pros. I'm Jeremiah Bates. He's Nick Daniels. We are fiduciary financial advisors. Not here to sell, here to guide, provide advice, provide education. The more education you have, the better you will be at making critical financial decisions. We are live, which means you can interact with us. I know we had some callers coming through. Seems like a few of them dropped. Hey, that's a part of the game. But if you have questions, we have answers. You want to change the topic. You want to talk about taxes. You want to talk about estate planning, retirement planning. You want to talk about SpaceX. We covered that earlier in the day or earlier in the hour. Please send it our way. 979-59-MONEY. That is 979-596-6639. You can send us a text message as well. We're going to go to the text lines because we got some good questions coming through over the topics we were talking about in the first hour. And this is, I'll kind of summarize this. We sold a rental property in 2021. An advisor that we were working with put us into one of these opportunity zone funds. The idea was that we didn't have to pay the capital gain on that sale of that rental property. We have not received any money from this fund. I just found out that the tax is coming due at the end of the year, meaning that 21 tax. Are we really going to owe the IRS money we've never seen? Not sure how to handle taxes for 2026. Yeah, I mean, it's an issue that, I won't say an issue, but it's going to be something that anyone who invested into a qualified opportunity zone that they're going to run into in 2026. I mean, so in this case, what they did is they sold a rental property in 2021. They were likely looking at a large capital gain. They were advised to roll that capital gain into an illiquid investment known as an opportunity zone. And in doing that, they did not have to pay the capital gain from selling that rental property in 2021. Now, fast forward to 2026. That's 5 years. So during that 5 years, that opportunity zone fund hasn't issued any dividends, any interest, or any type of return as far as income. And now that they're seeing that, hey, the deadline is in 2026, we're actually going to recognize that capital gain. How do we handle the taxes?
My hope would be that the basis that they kept out, because in this text it's saying they were advised to take the gains from the rental property, put those into a QOZ. Hopefully the basis that they kept, they
have access to it?
They have access to it, yeah. Whether they move that into a savings account, whether they took to the basis and maybe just put it into a brokerage account and had some investments, but hopefully there's some liquidity within the basis that they kept to help cover this tax bogey. Otherwise, one of the things I've been thinking about is just, man, how many people are going to be out there listening, and this might be you, listener, hanging out this weekend listening to our show. The only thing that you have is this QOZ fund now that you're sitting on. And then what if you're only sitting on pre-tax retirement accounts between you and your spouse? And you've got to take a chunk of change out of an IRA to cover that tax bogey. It's going to make you take out way more than you need to, because now you're going to have to account for your federal income tax coming out of an IRA, potentially state income tax, depending on where you live, to generate the liquidity needed for this QOZ tax bogey. It could really bite a lot of people.
No, it could. I'm going to cover the two questions that are kind of sticking out here, where he says, are we really going to owe the IRS on money we've never seen? Well, I wouldn't necessarily pose the question that way, because obviously you probably had a good return on the rental property. That's why you want to defer the taxes. Usually if you have a high taxable gain, it means you had a good return on your investment. So, I mean, essentially you just, instead of taking that money and paying taxes on in 2021, you just put that money into a different asset. Like, it's still there, you still own it, but it's just illiquid. I mean, a lot of people have this with equity in their home. I mean, your home has grown and appreciated over the past 20, 30 years. You own it free and clear. And it's like, yeah, I own over $1 million house free and clear, but all I have money is left over here. So you just might have to get creative. I mean, bottom line is you still got the money. Now we're just looking at some tax planning efficiencies. And then the next question is, not sure how to handle taxes for 2026. You got to get in front of this now. Like right. Meaning we're basically halfway through the year, a little bit over, maybe a few days over halfway through the year. You got to start looking at a number of things. You got to get with your tax counsel, and you got to uncover, what is that gain that you deferred? What is that dollar amount? Number one, get that set aside. Figure out what that number is. Now you got to look at all of your sources of income in 2026. How are you getting income? Are you getting it through Social Security? Are you getting it through pension? Are you getting it through dividend income for your investments? Grab that. Have you recognized any taxable events so far this year? Put that into place. Like, get a snapshot of all of those items now, because you have about 6 months of runway to do some effective planning to help mitigate that tax bogey. Even if your options are limited, at least you know what that's going to be, so you can start coming up with ideas of how to get the liquidity to cover whatever that tax bogey is. In this case, the last thing you want to do is sit idly on the sidelines, wait for your tax filing to be done, and you're just left scrambling. And the fact that you'd already be in the next calendar year, your tax planning strategies they're going to be few and far between. Really few and far between.
Yeah. I mean, like, I'm thinking, okay, what would be something helpful? Well, I suppose if we saw a huge market correction, like the AI rug gets pulled out from underneath us, and you've got a brokerage account where you could harvest significant losses to offset your taxable gains. But, being an advisor, I don't want to see anyone's accounts drop 20%.
No, not at all. And it's just, that this question, it's a great question. And this is it's going to be a situation that many QOZ investors are going to run into. And it just comes down to understand what it's going to be. How do you cover it? And simple as that. Make sure you get some good guidance, making sure you're working. If you got a good advisor that you're working with who can help analyze this with you, so they can look at the entirety of the situation. Like, also look at the dynamics of the funds that you were put into. Like, will they offer you any liquidity? That's something that you want to look at as well.
Yeah, and we hit on it in the earlier hour. I mean, all of these funds are so different and unique. Being that it's, we're looking at calendar year 2026, and so many of these funds were created in 2017, 2018 when these projects got going. You could also keep your fingers crossed and hope that they're, close to being finished, where, it could get sold to a different investor, maybe a DST fund or something like that, move from a QOZ into a DST fund where they're going to pick up this property that's now producing cash flow, and you might have a liquidity opportunity. It's on you to do the research, though.
Yeah.
At the end of the day.
Yep. Yeah, we got another text question. It's kind of along the same lines. It's from Eugene. We did one of these opportunity zone investments a few years back after selling some stock. My wife is asking if we were supposed to do something on our taxes every year because of it. We kind of set it and forget it. Want to make sure we're not behind on anything before that 2026 deadline. Same thing. You just got to you got to go back to that initial year that you got into these qualified opportunity zones. Figure out what the gain is. Then once you figure out that gain, look at the entirety tax situation of what you've done so far in 2026, what you anticipate, and then start getting some planning done. Make sure you get some good counsel, some good advice. Work with a good fiduciary advisor or work with some good tax counsel, and make sure you got all your data, all your tangible numbers for this year, so then you can start coming up with some strategies. It's going to be paramount. Great questions, though. Phone lines are open, 979-59-MONEY. That is 979-596-6639. We're going to go to the phones right now. We have Tom calling out of Los Angeles. Tom, what can we do for you?
Hi, thanks for taking the call. Question: I'm retired. I've got about $2 million in IRA assets. I'm looking to make a change from my current financial advisor, where I'm currently paying a percentage. And my question is, what is the advantage of staying with another advisor who, charges me a percentage versus doing a flat fee advisor?
No, it's a great question. I mean, it's I would argue it's where you're seeing your value. And the best example I can give you is working with clients. And we got a minute before the hard break. So, Tom, if you want to stay on the line over our break, please do. And Nick, I'd love to get your thoughts on this. But really, when you're looking at the difference between flat fee advisor and asset management, is flat fee, you've defined a scope of work and you're paying for that scope of work. Whether that's going to be from a financial planning standpoint, whether that's going to be analysis on an allocation, maybe it's going to be, really anything in your financial realm. But generally that scope of work is defined, that scope of work is completed, and you pay for that level of work. versus the asset management side of things, well, it operates functionally differently because you're getting active asset management, which we will talk about actually what that is and why it's suitable for some, but not for all. This is The Real Money Pros. We'll be right back. We are back. This is The Real Money Pros. We are live. Phone lines are open, 979-59-MONEY. That's 979-596-6639. I'm Jeremiah Bates, joined with Nick Daniels, Fiduciary Financial Advisors, here for you. Any questions you have, any topics that you want to chat about, please send it our way. You can call us, send us a text message, send us an email, Jeremiah@therealmoneypros.com, Nick, N-I-C, @therealmoneypros.com as well. We're going to go back to the phones. Tom, thank you so much for hanging on during the break. And it's a great it's a great question. This comparison of working with an advisor on a flat fee basis or versus working with an advisor that's charging an asset management fee. And correct me if I'm wrong, Tom, but you mentioned the advisor that you're working with. Are they doing assets under management for you?
They are, and I don't feel I'm getting my what I need to go to the next level now that I'm retired. And my problem is, I know enough to be dangerous, but I don't know what I don't know. So let me ask you this, Jeremiah: if I were to come work with you guys at your company, how dumb it down for me? How would a flat fee program work versus an assets management under management program work?
Yeah, Tom, if you don't mind, I'll jump in and answer that. I think it's important for all of our listeners to understand there is distinct work that is done if you're going with a flat rate plan versus asset under management. And I'll try to be brief and keep it high level, but on that flat rate planning, typically what the end user is going to be receiving is input on tax efficiencies. Are your assets not only are they located in the right places based on your goals now that you're in retirement? From pre-tax, Roth, non-qualified assets, you should be getting guidance on the most strategic ways to be pulling funds from your various resources in order to achieve your goals in retirement or continue to meet those goals in retirement. And it's comprehensive, right? It is evaluating what's your longevity, what kind of risks. There's a lot of risk management that goes on in your flat rate planning, meaning how are, if we're dealing with married people, what would the surviving spouse look like in the case of an unexpected and severe health incident or incidents where long-term care is needed? How would that impact your odds of success in retirement? So it's looking at all of those things. That is one that is planning in a nutshell. We're looking at all of these things. Mm-hmm. We're preparing contingencies for them. We're advising the client on here's where you should pull from, here's what you should do. The biggest thing to remember, though, that in flat rate planning, the onus for implementation is on the client. The way that we here within our office conduct flat rate planning, your accounts are not visible to us. I mean, you're more than welcome to bring in a statement so we can see the holdings, but we don't see your accounts. We don't have access to any of the things, any of these things. It's like a point in time.
Yeah, kind of like a point in time situation and analyzing mm-hmm. that, and then going based on that versus the asset management side of things. It's ongoing. I mean, there's eyes on it, and I would argue this. I mean, really, it could come down to if we're looking at these two items completely separate in a vacuum. But if I was going to answer your question directly, what you asked, it's like, hey, if you reached out to us and you said, okay, take a look at everything I got. Here's my take. Here's my desired outcome. Here's how I want retirement to look like. And then, we're going to talk through everything. And then as fiduciary advisors, we're going to talk about both and obviously work in your best interest. And again, sometimes, in my experience, if someone is really good at following a strategy, maintaining emotional composure when things get a little bit rocky or a little bit turbulent, like they can follow a set strategy that is analyzed based on what your spending needs are, what your cash flow is, what are the tax efficiencies on. A lot of times that flat fee side of things makes a lot of sense because it's like, hey, I don't know what I don't know. I know enough to be dangerous. I'm not chasing this wild hot stock tip. I'm not gonna sell out of the market when we see a big drop. Like I understand all that, but there's some complexities and some things that I feel like I could really benefit of having an experienced fiduciary advisor help me with. There's flat fee. Then it's great. Let's define that scope of work, charge a fair fee that we all agree on, and then let's go execute it. Let's get it done. Versus the asset management side of things, let alone just the portfolio construction, the tax management of like active tax loss harvesting, Roth conversions, capital gain management, charitable gifting strategies. Nick already touched on the retirement income planning, like the risk management, but there's also specialized strategies. And I'm not saying that you should work asset management just because advisors have a specialized strategy they have access to, but direct indexing, alternative investments, access to private markets, structured notes. Tax overlays, working with derivatives. A lot of times in most cases, these are just not available to the retail investor. So that's where that asset management could make a lot of sense. And that doesn't mean that the entire amount of money that you have available to you in your plan needs to be charged a fee to cover those strategies. Maybe only a portion of it is, right? So meaning in our case, never try to fit someone inside of a box of, okay, this is what we're doing, this is how we have to do it. It's let's explain it, let's understand what the overall objective here is, and then we talk about our process of how to get you there. And maybe it's a combination of flat fee and AUM. Maybe it's just or assets under management, as we like to call flat fee. In combination with assets management, maybe it is just assets under management, or maybe it's just a flat fee. So it's the answer that everyone loves, Tom. It depends. But in your case, you brought up something that you said that I think is really important to touch on is that as you enter retirement and the advisor relationship that you have, if it's just passive asset management, yeah, I would argue that the fee that you're paying, you're not getting enough value from it. Like, because when you cut that corporate cord or you sell your business and now you're looking at this delayed gratification really has to now translate into quality of life impact. Now there needs to be a much deeper dive, and that financial planning side arguably is going to be paramount. It's going to be so crucial to make sure that you feel really good, not only about the fee that you're paying, but you just feel really good about the trajectory of your retirement. You got the tax side of things tied down and handled, and on top of all the other items. So hopefully that answers your question, Tom. Anything you think we've missed there? I know it's kind of drinking from a fire hose.
That's awesome. Just one last follow-up. For someone who hasn't executed a plan like this, because I don't do this every day like you guys do, that scares the shit out of me. How would I be able to execute the plan if I've never done it?
Yeah, that's where the guidance of an experienced, again, I'm going to say fiduciary advisor is going to be paramount. So again, and you're not alone on this. And Tom, you're not alone on this. When you're entering into these uncharted territories of retirement, having a plan and making sure that you leave no stone unturned. So yeah, you mentioned it. You don't do this. Like you did all the things that you were supposed to do: work, delayed gratification, save money, and now you're at this point where you're like, I got to feel really good. Well, that's where you work with someone that you can trust, a good communicator, and make sure that they know what you want to do, and then they lay out the options that are in your best interest. That's going to be my answer to that, Tom.
Yeah.
We're up against a break. We certainly appreciate the call. Again, phone lines are open, 979-59-MONEY. That's 979-596-6639. We'll be right back. Welcome back to the Real Money Pros. I'm Jeremiah Bates. He is Nick Daniels. We are live. Phone lines are open, 979-59-MONEY. You can send us a text message as well, 979-596-6639. We actually got a good text question that came through. I want to read that right now. 74, I take my RMD, which is your required minimum distribution, every year, but I don't need the income. I just pay tax on it and donate a chunk of it to our church. My daughter heard you guys talk about QCDs a few months back and told me to ask about it. Am I doing this wrong? It sounds like there's a smarter way to handle the charitable piece. I've been self-managing all my stuff. Thanks.
That is a great text question. So thanks for sending it in, first of all. And yeah.
real quick, Nick, this is kind of going to piggyback on Tom's question that he just asked during the last segment of like, he's working with an advisor and he's paying a fee and they're managing the assets, but it sounds like he's not really getting comprehensive advice. This is a great question that came through that arguably has nothing to do with the actual investment performance
correct
of your assets, but certainly moves the needle as far as quality of life impact and saving money on tax efficiency. So, yeah, I would argue that if you are paying for asset management and you are not getting the comprehensive, I know you could argue that's a jargony term, but that comprehensive wealth management side of things, this is a perfect example of like rubber hitting the road. Like if you hear that word, this is a part of that.
Yeah. So let's define what is a QCD. It's a qualified charitable distribution out of your IRA, right? And what that does is it is sending money directly from your pre-tax retirement account to a 501c3 of your choice, all right? So the custodian, in this example, I'm going to use Schwab. You instruct Charles Schwab to to mail a check directly to, and I'm just going to take from this text, this guy says he's donating a chunk, that's his words, a chunk to our church anyway. So you can instruct Schwab to mail a check from your account directly to your church. Now, a qualified charitable distribution does two things. Number one, it eliminates your tax obligation on that because you're getting credit for donating money to a qualified charity. So let's just say it's $10,000. You're sending $10,000 out of your pre-tax IRA, but you don't have to claim $10,000 of income, right? So you're getting to eliminate your income tax on that $10,000 check that's being mailed to your church. Your church, in this example, is receiving that $10,000, and they're a 501c3, so they don't have to pay taxes on that. It's really, really good. The second thing, tying in back into his question, he takes an RMD every single year. Well, you can use a qualified charitable distribution in the entire amount of your required minimum distribution, and you're killing two birds with one stone. You are satisfying the IRS rules that say you have to take a certain amount of dollars out of this pre-tax IRA. You satisfy that IRS rule, and then you get the secondary tax benefit of making a charitable donation. You're not paying income tax on those dollars. It's a very tax-efficient move, especially for people who are charitably minded. In this example, he's using church, but it could be any 501c that tugs at your heartstrings. The Humane Society, Wounded Warriors. There's all sorts of 501c3 organizations out there that you can do a qualified charitable distribution out of your pre-tax IRA. It's keeping the taxes out of the hands of our government, which, listen, I love our firemen. I love our policemen. I like it when I flush the toilet, the water flows. I like my sewage. I like those things. I don't feel like governments in general are the most efficient with all of their tax dollars. So I don't want to give them extra. That's all I'm saying. I don't want to give them extra.
Fair enough. I think when you're looking at it, this is a tax play, and then we're talking about tax efficiencies. And to understand really the benefit from a tax standpoint of a QCD, I think it's helpful to understand like how this logistically flows into your actual tax return. Because let's imagine that this gentleman, we got a name on there. So this gentleman, 74 years old, has to take money out of his IRA, but he does not need it. So he's just taking that money out of his IRA into his bank account. So what does that mean from a tax return? His IRA is going to generate a 1099-R, let's just say it's $50,000, that this gentleman took $50,000 out of his IRA, which is now going to just add into all of his other taxable income. And that's going to be taxed at ordinary income rates. Okay? So meaning that $50,000, we know that it's going to be taxed at whatever his ordinary income tax rate is and whatever his state income tax rate is. Now, he took that money out of that RMD, just took the cash and donated it to his church. So let's just imagine he did, I don't know, let's just come up with an amount, but let's just imagine he did a portion of it. Now we're looking at the deduction side of things, because we're all familiar with it, whether you're self-preparing or you're working with your CPA. It's like, hey, give me a list of all the itemized deductions that you had for the year. Well, in this case, if he's 74, we already know that standard deductions. I mean, for 2026, I think the standard deduction for a couple married filing jointly,
about 33 in 2026.
Yeah, let's see. It's a little. I'm gonna look this up real quick. Standard deduction. Hopefully, I can get it. 32,200. So for 2026, we know that the standard deduction is 32,200. And then add in that if he might be eligible for the enhanced senior deduction, which
Correct.
is six. If you're over 65, that's $6,000 for each individual person. So now you got 32,200. Add another potential 12,000 on top of that. You're already at 46,000 of standard deduction, meaning your itemization to include your charitable donations, your medical costs, those eligible items, they need to exceed that standard deduction. In most cases, people aren't itemizing up to that standard deduction, so they're taking that standard deduction. This is where the QCD helps, because in that example, took money out of IRA, taxable as ordinary income, then sent that money to the charity, and depending on what amount, probably won't move the needle that much because he's going to take the standard deduction. So how about we do away with that, with that high standard deduction, and let's do the QCD, the qualified charitable distribution, where that money going from the IRA doesn't show up as taxable income on your tax return at all. Like, it's just not there. Like, it is not included in your overall gross income when you do a QCD, depending on how much you do. Now, Nick covered the logistics of it. It just goes directly to the charity. That is the benefit. You're still getting the money into the charity, but you're just changing the logistical process of how you're doing it, which translates into significant tax savings a lot of times, especially if you're charitable minded in this regard. And if you're charitable minded, that money that you save on taxes, the next year you can even do more as far as a charitable contribution. So that's the benefit of that QCD.
And my mind goes back to Tom's call, back to the difference between planning and asset management. One of the things to think about is, okay, let's say in this guy's scenario where he's just taking the full distribution, even though he doesn't need the income. I think it's fair to say if it's $50,000, I mean, just to use the example of the dollar amount that you used, Jeremiah, at $50,000, it's probably likely that he could be in the 22% tax bracket, depending on the state. I think it's fair to say that you could be looking at it all in, of maybe a 30% tax on that. So that's $15,000 that disappears right away to taxes. You're going to give the rest to this charity of choice. So you're going to give $35,000 to a charity versus if you do a QCD, you're giving the full $50,000 to charity. The other thing to keep in mind, though, is in doing a QCD, keeping your taxable income lower, does that create an opportunity to harvest gains in a non-qualified account?
Or Roth conversions.
Or a Roth conversion, where potentially you're recognizing gains and paying a 0% long-term capital gains tax or giving you room to do that Roth conversion. So there's a lot of different components to play in. That's what you get with comprehensive planning.
And by the way, if we add on to the comprehensiveness of this conversation, don't forget about your IRMA charges, which is tied to Medicare. So in this example, if this gentleman has been taking the RMD to his bank account, paying taxes on it, he might be paying more in Medicare Part B premiums than he needs to, because your Medicare Part B premium is based on your gross income. And if we can reduce your gross income by doing the QCD, meaning that $50,000 wouldn't even touch, that's the example we're using, wouldn't even touch your tax return, then maybe you're saving money on your Medicare and not running into those IRMA charges. You can see how there's some moving parts here, but again, to bring it all the way back, who's giving you advice? I mean, good financial decisions don't happen by accident. You got taxes, retirement, business decisions. You need more clarity around your financial future. That's really what Tom was talking about. And my answer was this: the right guidance matters. Having someone in your corner, an experienced fiduciary advisor that can help that's a good fit for your situation, who you can bounce ideas with and get you to your desired outcome in the most efficient way. And maybe that's via QCD. Visit therealmoneypros.com, click on Find an Advisor tab, and we'll help you get connected with an Apollon Fiduciary Wealth Management Advisor. We'll be right back. Welcome back to the Real Money Pros. Again, phone lines are open. We're live. Hour 2 of our 3-hour live program. If you don't get a chance to call in this last segment, just give us a call going into the third hour. I know we're covering a lot of markets here. If you're picking us up for the full 2 hours or 1 hour and you think that you missed anything that you wanted to go back and get caught up on, visit therealmoneypros.com. It's where you can get access to our sponsors, find our educational content, sign up for our newsletter so we can keep getting you that good information feeding along the way. We try to get at least one podcast / video at least once a week, so we've been pretty consistent with that. Sometimes we do more, depending if we have a timely item that us as a team, we feel like we want to get in front of you. So again, that is therealmoneypros.com. You can call us 979-59-MONEY. You can text us 979-596-6639. Got another text message kind of along the lines of this these tax deferral strategies. And I'm all for being tax strategic. We give to a few charities every year. Nothing huge, maybe like $1,000 each. So I'm assuming it's a married couple. We take the standard deduction, so we've never really gotten a tax break for any of it, which we talked about. Someone at our church mentioned a donor advised fund might change that. Is that something that actually works for regular people, or is it more of a high net worth strategy? Tom in Florida. Great question, Tom.
I'm letting the wheels turn on this one.
Well, okay, let's talk about again, we talked about this a little bit. Donor advised fund, it's just an account. So don't let the donor advised fund make it seem like, oh, we got to create a fund. That sounds like a lot of work and a lot of moving parts. It's really not. I mean, donor advised fund, think of a donor account. It's an account that you set up, that you own, you control. You can invest money inside of a donor-advised fund account because you are the donor. That is your account. You can invest money inside of it. You can donate appreciated stock. Really, that's the functionality of that account. Now, where it makes sense, why do people do it? It's because you can, instead of gifting directly to charities, what you can do, let's imagine you have a high tax year. And we did this with a client a couple years ago. High tax year. It was just one of those outlier years. They're extremely charitable minded. So basically we said, well, let's front load your charitable gifting for a long period of time. So what we're going to do is because your income is so high, we're going to do a large donation into this donor advised fund. So just in doing that, from a tax standpoint, that's as if you were gifting money to the actual charity. It's going to go on your Schedule A under that itemized deduction that you gifted to a charity. But instead of going to a charity, it's just going to the donor advised fund. Now we get into the rules of that donor advised fund or that account. You can't pull the money back out, if I'm not mistaken. Meaning it has to be used. That money has to be used going to a charity to get the tax benefit. Now, the tax savings is on the money going into the donor advisor fund. After that, the money going to the charity, that's just following your charitable desired outcome, meaning the dollar amount, what charities you want to send it to. You can do these donations anonymously. You can do a certain name on these funds. So when that check actually goes to that charity, it could reference you as the person who gifted it, or it can be anonymous. But to answer your question, is this a strategy that works for regular people or is it a high net worth strategy? Again, it just comes down to what makes the most sense. I mean, if you're charitable minded and we're trying to be tax efficient, then do you have an opportunity to do a large contribution into that donor advised fund that exceeds that standard deduction? Well, now you're talking about tangible tax benefits. Or if you have a highly appreciated stock or piece of real estate, that you could put into that donor advised fund, then that would make a lot of sense as well. Meaning there's not some net worth break point where this makes a lot of sense. It really just, you got to look at your situation. Are you charitable minded? And is there some tax efficiencies that you're missing out on that you could use that donor advised fund as a tool?
Yeah, I also think too, to this text question is, what's your end game with the donation? Because once that money is inside that donor advised fund, again, you can't directly benefit from it, right? So like you couldn't, not that I would encourage anyone to buy a REIT, but like you can't purchase a REIT in that, and then you're taking the passive income from that on a monthly basis while the donor advised fund owns the REIT, right? You're not going to get a direct benefit after the deduction on your taxes. But if your end goal was to say, well, I want to take this $1,000 that my spouse and I each put in, so $2,000 a year, we want to put it into this donor advised fund, but we want to try to grow that money before we then distribute it to our charities. Well, you do have that opportunity within a donor advised fund. You could reinvest that cash, and say you just pick an index fund, which is about to contain SpaceX if it's QQQ, right? And SpaceX takes off. Then every single year you could just take some cream off the top and distribute those gains tax-free to your charities of choice. So if your end game was to try to donate money but then grow that money before gifting it, a donor advised fund could work for you.
Yeah, and sometimes the process of doing it, like, it depends on how many charities. If it's just a few, then no big deal. But I worked with some people where they got a long list of charities that they like to give to. I mean, it's long. We're talking about well over a dozen that they're gifting to on an annualized basis. And what I found is that using the donor advised fund, I mean, let alone the tax efficiencies that we're getting from it, but using the donor advised fund as the mechanism to just send those donations or those grants or whatever term you want to use, it's just easier. It's just been a little bit easier, a little bit more streamlined, just in my experience from what I've found. So, yeah, to answer your question directly, Tom in Florida, yeah, you can certainly do it. It's certainly a valid strategy. You don't need to be in that, air quotes, high net worth strategy. Just look at your situation, reach out to your advisor, reach out to us, and see if it makes sense. Like, I always look at this too, is like, is the juice worth the squeeze? Or like, is that return on time? Is there just return on hassle? The tax tail can only wag the dog that much. So, I mean, setting up a donor advised fund could make sense, or it could just be more moving parts in another account that may otherwise not be needed. But the only way you're going to find out is if you get some good guidance, take a look at it, uncover your end goal with this, and see if that donor advised fund, aka that account, makes sense for you to use for your charitable endeavors. Great question. 979-59-MONEY. That's 979-596-6639. You can call us. You can text message us. But kind of along these lines, really around these tax deferral strategies, it's kind of what we're looking at. It's how a lot of times there's so much focus on the performance of an investment, but many times it comes down to what is not the asset allocation, it's the location of your assets. So we've talked about donor advised funds. We talked about the qualified charitable distributions and how that could be beneficial. There's other deferral strategies. We talked about opportunity zones in the first hour. So if you're, number one, if you were in an opportunity zone, if you're in one right now, pay attention to it, because December 31st, 2026, that deferred gain, you're going to run into some issues. 1031 exchanges. There's so much highly appreciated real estate out there that may no longer be serving you. I mean, case in point, I met with one of my clients. They have a rental property down in Arizona. They don't really want to jockey around with managing that property or having someone else manage it. They use it as a kind of a short term where they really only rent it out to one person that snowbirds down there because they just don't want to deal with the hassle. But bottom line is they're losing money on this just from the maintenance, the taxes, all of that. It's like, geez, but and this is the comment that they said, well, our accountant said if we sell it, all of our profits are going to go towards taxes. I'm like, okay. I'm like, let's actually look into that. I mean, yes, there will be taxes, but to come with that egregious statement that all the money's going to go to taxes, let's actually look at it. Now we looked at it, and yes, if they were to sell it and take the just liquidity, large taxable gain. I said you could look at doing a 1031 exchange, meaning just move that gain or your basis or all of it to another type of real estate investment. Maybe it's something closer to home, a better opportunity, or you could do a Delaware statutory trust, which again is completely passive. You don't need to manage the tenants, the toilets, or any of that. So there's plenty of deferral strategies out there where you can be tax efficient and have your cake and eat it too.
Yeah, this is why you want to engage with a qualified wealth management advisor who's well-versed in all the nuances. No one's going to know it all, but you should at least be working with someone who's been exposed to it all, knows the questions to ask because you don't know the questions to ask. Thanks so much for listening this weekend. We'll see you next week.
Welcome back to the Real Money Pros, hour 3 of our 3-hour live program. I'd like to welcome in Chicago, welcome in California, and whoever else is getting us live right now. You can interact with us. Call us, 979-59-MONEY. That is 979-596-6639. I'm Jeremiah Bates. He is Nick Daniels. We are fiduciary financial advisors. This is a financial program. Now, we are not here to sell anything. We are a sponsor-driven program, and Nick and I, we are practicing fiduciary financial advisors. We've been doing this for a number of years now. We meet with hundreds of clients, probably thousands at this point during our career. And the cool thing about broadcasting on the radio and doing, practicing financial advisors is they complement each other so well. Because when we broadcast on the show, we can take these real-life conversations and these strategies and these cases that we're doing on a weekly basis, and we can grab those and we can use those as experience and create visuals and kind of distill them down to what we feel would be important or a good topic to cover on the show. And then vice versa is that doing the show, a lot of times we got to talk, what's happening in the news. Like we had SpaceX IPO, and then we got to find a way to make it interesting and also so understandable and theater of the mind. So they just complement each other so well. But what I want to tell you is that we are live. You have questions, call us. We will answer it live on air. You can text us, and we'll answer it live on air. We've been getting a lot of calls throughout today's program, some great text messaging questions. If you've missed the previous first 2 hours, go to therealmoneypros.com. You can catch our podcast, sign up for our newsletter, get access to our wonderful sponsors. Because, again, we're here to guide. We're here to provide education. We're here to do this every Saturday. SpaceX IPO, let's touch on that, Nick. I know we touched about that in the first hour, but SpaceX IPO, it was a marquee event, a lot of hype, arguably one of the, what some are calling, I don't know if you'd say the most important, but certainly the most attention-grabbing IPO that I think that we've had in a very long time.
Oh, for sure. For sure. I mean, generating, what was it, $75 billion they raised in their IPO. So that made it the largest public offering in history. It's going to rapidly be included in the NASDAQ 100, rapidly be included in Vanguard-specific funds like VTI, VUG, and for retirement plan participants who have Vanguard funds in their retirement plan, their mutual fund VTSAX, it's going to be included in that, probably, honestly, in those Vanguard funds within around 5 business days. So don't feel like you missed out if you weren't able to purchase shares on Friday. Give it a week, and you probably now have a minority stake in SpaceX.
But one important statistic. So this was, I think it was a university out of Florida who was looking at IPO data going back to, I think it was 1975 going to 2021. Out of, I think it was 9,000 companies that IPO'd from that time over the first 3 years. It was a very small percentage. Well, over 50% finished lower, flat or lower.
I think it was 60% were flat or lower after the first 3 years of the IPO. And 5 years down the road, I think only about 16% of those companies had doubled from their IPO share price. So that's less than 1 in 5 companies over that time span actually doubled their share price. The majority of them, you lost money, which we were getting so many questions leading up to the IPO of SpaceX that, my follow-up question to anyone who was saying, well, should I be buying some now? Should we be getting exposure? Should we? One email said, are we? The question was this: are we jumping on the SpaceX bandwagon? And the follow-up is typically, well, how long do you want to hold it? Because if you're going to buy and hold it, we're probably going to see a lot of price volatility in the first few weeks. So your entry point doesn't necessarily need to be supposed to list at 135. As soon as they finally started trading, it traded right at the beginning at 150 a share. I was like, you're probably not going to miss too much there. And then, the second question is, well, why would you buy it anyway? Because so many of the people that we work with, I would say, Jeremiah, are at a point now where they're no longer in an accumulation mode. They're in a decumulation mode, where it's a strategic drawdown on assets. And while they're drawing those assets down, they also need to be receiving passive income from those assets as a nice supplement to what's coming in through Social Security, pension sources, things like that. The shoe wouldn't fit in that case because SpaceX is not going to be paying you a dividend, while you own it. So, yeah, that's kind of the SpaceX rocket that has been launched.
Yeah, I think, and it's interesting when you look at just other big notable IPOs where some of them actually fell flat first day. Facebook back then, which is now Meta parent company of Facebook, the app that I think many people are familiar with, that kind of had a falling on its face IPO. But I wouldn't be surprised for SpaceX to have an initial surge like we saw on Friday. That momentum might continue over the next few weeks, and then it'll likely be followed by some soft weeks. And just expect volatility. I think that's going to be the case when you just look at the size of the company. Then you add in the inclusion of these broader indexes. You add in the ability for the private holders of SpaceX, where they have a bit of a tiered schedule in which they can sell their shares on the open market. You're going to have that eventually enter in on a grander scale. But overall, like many companies, they have long-term success after that. And when you look at SpaceX, it's the different ventures that it's in, the possibility of SpaceX actually including Tesla in that Elon Musk has alluded to. It certainly fits the longer-term growth bucket, if you will, of your investment strategy. And Nick, I'm glad you brought that up because I think with what we're seeing with SpaceX, it's always an important reminder. Understand what the point of your investment is. Like, money's a tool. Investing is the investments that you own are a tool. And what tool? Like, what purpose is it serving? And if you put that into your decision-making protocol, then you're going to feel really good about wherever SpaceX goes. Because if you did that due diligence and you created that foundation, a framework to make that decision to invest in it, whether you have or you're going to continue to do so or you already did, well, you understand why. And then once you understand why, if it continued to goes up, great, you've already taken that into account. Or if it continues to go down, then you've taken that into account. But bottom line is you have a strategy behind the reason why you bought it. Because where you could run into trouble is if you were just shooting from the hip and you wanted to buy into this hype, if you will, and then it goes completely opposite. Hopefully you took that into your decision-making protocol so it doesn't take away liquidity or your financial outcomes not left into question just based on the performance of one investment.
And, I mean, it can happen to the best of us, and maybe I shouldn't say the phrase the best of us, but it can happen to anyone. Look, I bought into the hype years ago with Rivian. Like, I'm a big truck guy, automotive guy. I just think they're cool. Cars and trucks are cool. Horsepower is awesome. Like, I believe the answer to every solution is more horsepower, right? Or the answer to every problem. But, I had been reading the car magazines, the truck magazines leading up to the launch of the Rivian electric pickup. I was looking at its horsepower numbers, performance numbers, all that stuff, thinking, man, this is going to be awesome. And I bought Rivian at its IPO, which was like, when it launched at like $119 a share. And it plummeted from there. Today, all right, and it launched in 2021. So we're not quite at 5 years. In November of 2026, we'll be at 5 years in. I mean, I bought it at like $119 a share, and it just bombed. It's currently trading at $16.76 a share is where it closed on Friday. I mean, it is down $100 per share after 5 years from where you bought in, right? And that's an example of these IPOs where there can be a lot of hype. I've since sold it because it just was like, I was telling somebody the other day, like when I was a teenager and I was getting ready for a date and found a big old like zit on my forehead, I was like, no, I can't have this. Like, I can't stand this look on my face, Every time I would look at my account and see Rivian and see the red, I was just like, no, that's the zit on my forehead. I gotta get rid of this thing. So, I sold it. You're gonna have to hang on to Rivian for a long time if you're hoping to get that profit back, right? The same thing is kind of true. If we want to talk about like Elon Musk led companies, Tesla's story was kind of similar. They launched in, when did they launch? I think it was 2012 is when they went public, and they struggled initially. There was a big run up in the first few days, but they struggled 3 years later. Their share price was really hurting because they were having trouble bringing product to market and scaling.
Volatility, it's a part of it. We'll be right back. And we're back. This is The Real Money Pros. I'm Jeremiah Bates. He is Nick Daniels. We are fiduciary financial advisors. Sponsor-driven program, not here to sell you anything. And the beauty of this program is we are live. You can interact with us. You want to change the topics that we're talking about? That is great. Let's talk about taxes, estate planning, retirement planning, college planning, how to maybe exit out of a highly appreciated stock. What are the strategies behind it? Or maybe you heard of a Roth conversion, heard of direct indexing, heard of qualified opportunity zones. You're like, what actually is that? And how does that apply to me? Well, you can call us or text message us, and we'll give you the answer. 979-59-MONEY. That is 979-596-6639. Qualified opportunity zones, I think it's important to cover this again. We talked about this in the first hour of our program, but I know that some markets that are picking up in this hour, you don't catch us in the first hour, so we want to bring it up again. Qualified Opportunity Zones, QOZs. There's an important date to pay attention to, which is December 31st, 2026. If you were an investor in these Qualified Opportunity Zones, which Nick and I will explain actually what these are, but if you invested in one of these based on the Tax Cuts and Jobs Act of 2017, because maybe you sold a business, sold a piece of real estate, whatever the case is, and you wanted to delay that capital gain by investing in a qualified opportunity zone, that deferred gain is going to become taxable this year. So if you're listening to this and like, wait a minute, I had a let's say $1 million gain from a business sale back in 2023, and I put that gain in a qualified opportunity zone, and now that $1 million capital gain is going to be recognized in 2026. Is that correct? The answer I'm giving you is yes.
Yes, we are nodding our heads. Yes, you have a tax bogey that you need to be aware of. One of the challenges with these qualified opportunity zones, and if you're in one, hopefully it was made very, very clear to you from the beginning. These qualified opportunity zones were a great way to defer long-term capital gains, not delete, right? Big difference between deferring gains and deleting gains. But it should have also been very, very clear that these are illiquid investments, meaning once your money's in, you need to anticipate probably 10 years minimum before you can get your money back out. That's what we mean by illiquid. And what are these qualified opportunity zones? Honestly, the easiest picture you can think in your mind is they are construction projects meant to revitalize industrial areas within cities, downtown areas within cities, and they've worked from that standpoint because they saw a mass influx of capital gains that people were not wanting to pay taxes on immediately. So there was a huge influx of cash into these qualified opportunity zones or qualified opportunity funds, right? And there are all these various projects, but the problem is construction sites, they're building things that will eventually have tenants. Whether that's retail tenants, whether that's live-in tenants, apartment complexes or whatnot. But while they're being built, there is no income being generated off of it. So you have an illiquid investment that people have rolled gains into to defer or delay the taxation on it. But you also haven't been getting any sort of positive cash flow from it while you've been in it. So to Jeremiah as an example, if you had $1 million in long-term capital gains and you're like, I didn't want to pay the taxes on that in 2023, so I rolled it into a QOZ or QOF, well, you're going to have to realize a $100,000 gain in tax year 2026, and you're on the hook for the taxes on that. And the question is, where will you come up with the liquidity, the cash to pay the tax bill that will be due on April 15th in 2027.
Yeah, the reason why I want to bring this up is because we're halfway through the year, and that taxable event is going to act as if you sold that asset that you originally deferred in 2026. You still got about 6 months. You got maybe 5 months and a couple weeks, meaning you got plenty of runway. So meet with your advisor, meet with your tax counsel, or find a good quality advisor, find some good tax counsel, and get a snapshot. Find out what that gain was deferred, like the actual gain that you deferred in whatever year you got into these. Make sure you have that inventory. Get an inventory of what your anticipated income or any taxable events that are going to happen in 2026. So at minimum, you have a clear snapshot of, okay, if we do nothing, here's what this is going to look like. Then you could look at the various strategies that are available to you, whether it's some type of tax deferral option, maybe you're charitable minded. Obviously, those are at your disposal, whether it's a donor advised fund, which we talked about the last hour, some charitable contributions, maybe it is some tax loss harvesting through some other assets that you have that you could sell at a loss to help offset that. And that's just a few, just barely scratching the surface here. But again, if you have questions on this, you can call us, you can email us, go to therealmoneypros.com, because it's an inevitability that is coming down the horizon relatively quick. So you want to make sure that you are prepared for that, because you don't want surprises when it comes to taxes. Another thing too is especially understanding if you have this big taxable event, making sure that, should I be making additional quarterly payments so I'm not penalized for lack of withholding through the year because I have this big event? Or maybe you're on Medicare and recognizing this income this year could potentially increase your Medicare Part B premiums. These are just things that you want to take into consideration when it comes to these qualified opportunity zones. Not saying that they're bad, just saying that this is a part of the structure. But that Tax Cuts and Jobs Act of 2016, it's rules based. So anyone who is involved in that. Now, there's a lot of different funds out there that you could have possibly participated in. And there's a lot of different fund sponsors. So I'm painting with broad brushstrokes, but if a lot of these funds were planning to do a level of refinancing within the fund at the fund level, which then in turn would create a liquidity event, which then in theory would give you the ability to cover that said tax bogey. But what we're finding is with the interest rates and some dynamics going on, that a few of these funds are not doing these refinances to actually create that liquidity event. So again, want to put it out there. If you want some extra analysts, some extra eyes on it, if you're like, wait, I got into QOZ and I didn't know any of this stuff was going on, what do I do? Email myself or Nick, Jeremiah at therealmoneypros.com, Nick at therealmoneypros.com, or we can get you connected with an advisor local to you, or that's a good fit for your situation that can really start to help you deep dive into this.
Yeah, I think if you're looking for ways to possibly offset the gains that you're going to incur, and we've talked about this in that first hour, so you can always go back to the archives and listen at therealmoneypros.com. But a donor advised fund, if you have a highly appreciated stock or some other highly appreciated asset and you're charitably minded and you want to open up a donor advised fund, don't think of it as a fund. It's just an account title. You're opening up an investment account that can receive this highly appreciated asset. You can get a tax deduction for that, hopefully in an amount that would offset the capital gains tax, or at least minimize that tax bogey you're looking at. Remember, with a donor advised fund, they're great for people who are charitably minded, but you cannot directly benefit from any of the investments inside of that fund. If you need to come up with some sort of offset but still receive passive income, you might want to consider a charitable remainder trust, because then you can set this up, get a tax deduction for your donation, and receive some passive income.
It's that balance between liquidity and tax efficiency and investing. These waves kind of lap across all those shores. And that QOZ deadline or that QOZ event that'll take place in 2026, just don't get caught off guard. Again, this is The Real Money Pros. We've got to take a break, but give us a call or text us, 979-59-MONEY, 979-596-6639. Welcome back to The Real Money Pros. TheRealMoneyPros.com is where you can find us. We're here every Saturday to talk through topics. Whether you're navigating retirement, taxes, business decisions, or you just want more clarity around your financial future, having the right guidance matters, because good financial decisions do not happen by accident. Sometimes lucky financial things happen by accident, like you just put a little money in maybe a cryptocurrency or a stock and it grows to it has a rapid ascent. That's fantastic. But let's remove luck aside. Those good financial decisions usually have some level of plan, a strategy, some guidance behind it. And that's what we're here to do. We have a whole team. We have a whole network of fiduciary financial advisors across the country, and we can get you connected with one of those advisors. Visit therealmoneypros.com, click Find the Advisor tab, and we will get you connected with an advisor who's a good fit for your situation.
Yeah, and sometimes, Jeremiah, I like to think about like different advisors have different skill sets. And I don't want to throw anybody under the bus or anything like that, but oftentimes, okay, think about it like this. Like if I was going to get into camping, I'm going to go talk to someone who's camped before. Right? So maybe I'm driving through my neighborhood and I see, oh, that person has a camp trailer in their garage or in their side yard. Let me go talk to them, learn from them, like what are the nuances that I need to know to get into camping. And that person could be an amazing resource telling me all about how you winterize an RV, the things you need to look into when you're looking at buying an RV. Go use, look at Facebook Marketplace because they depreciate so fast, like kind of all these things, and that'd be great, right? And that'd be great advice for what you're doing. But if you're the type of person, and maybe you do that, you get into that RV and you kind of do that RV camping for a while and you enjoy it. But what happens if then you shift and you're like, but I want to do more of like backpack camping. I want to do something that's more arduous, more strenuous. I want to get away from people farther where now I'm carrying my food and my shelter on my back. You're going to need to talk to somebody different, right? The person that can educate you about RV camping may not be a very good source to educate you on backpack camping. So you need to find a new resource. And life can be like that in your financial journey. Oftentimes, like the person that got you on your journey, financially speaking, maybe just like a plan, your employer plan sponsor provides an advisor to talk to like once a year. You get to sit down and ask them about questions about your 401k and the investment selections, right? That could be someone that gets you a start on your financial journey and helps you along, but they may not be the right person to then help you refine it as your life changes. It's not a bad thing to seek out a fresh opinion, a fresh view on your finances, because let's face it, in life, we can outgrow our professionals, whether that's a financial advisor, whether that's your tax professional, whether that's your estate planning professional. Like, life changes. Hopefully, your trajectory has always been like onward and upward personally, right? And it's okay if you outgrow that person and need to find somebody that's going to give a fresh set of eyes, ask you new questions that maybe you never even thought of, and help you refine your financial plan.
Yeah, and a lot of times you hit higher degrees of sophistication that the advice that you were getting before just isn't keeping up with your growth and your level of sophistication around your financial picture. So I think it's well said. 979-59-MONEY. That's 979-596-6639. Give us a call. Send us a text message. We are live. We're going to go to the text line right now. I've got a question coming in. I'll try to summarize this. I'm currently on Medicaid. My only real assets left is my house. Nothing, let's see. It's kind of weird wording. Maybe worth about $450,000. I want to bless my daughter somehow, but I don't know how much. Can I gift my house at some point? I just can't afford not to be on Medicaid. Okay, so if I was going to summarize this question, sounds like person's on Medicaid. They still have their house that has some significant equity into it. They want their daughter to basically receive that equity, gift the house, but they want to know, how does this potentially affect the Medicaid benefit? It's a good question. So I'm going to paint with broad brushstrokes here because I know each state has different rules and how they look at assets and they look at income for your Medicaid eligibility. But I think looking at the process of Medicaid is important because there's this term 5-year look back that I think is thrown around a lot. And really the idea behind Medicaid planning, like let's assuming that you otherwise would not be eligible to be on Medicaid just because you have too much money that you make from Social Security, maybe a pension, maybe you have investments that you're getting income off of, and then you also just said you're sitting on a large cash, like meaning if you were to go apply for Medicaid benefits because maybe you didn't want your cost of long-term care, and to be clear, I'm talking about Medicaid long-term care, by the way. Right. So this is what we're assuming here. So the long-term care side of Medicaid. And the idea behind this is that, well, if we can do some Medicaid planning, then not all my assets are just going to be used to the cost of care. So let's do some Medicaid planning so we're getting that cost of care through Medicaid, so then my beneficiaries can receive the value of my estate. Okay, so you have the application process where they're going to look at, okay, do you qualify? Do you make too much money or not? Or do you have enough assets or not? And that's why they're doing that. And that's when they're doing that 5-year look back. They're going to say, okay, from the point that you apply, we're going to look back 5 years. Okay. And then if you've gifted or removed, and they'll look at your financial records. I mean, they have a whole process of like a level of watchdoggery to see, okay, did you gift an asset? Did you have a bunch of cash or investment accounts that all of a sudden disappeared and you gifted to someone? Okay. We're going to put a value, like whatever that value is, and some states have a divisor. So basically you run into a penalty where they say, okay, based on that amount, you're not going to be eligible to be on Medicaid for this amount of time, which means you need to cover that cost of long-term care on your own. And then once you pass that time, then in theory you would be eligible for Medicaid. To be clear, I'm not an expert in Medicaid, just kind of giving you high level here, right? So now in this case, this person obviously got approved on Medicaid. They're receiving Medicaid assets. They're home. In many states, if not all, I think your primary residence up to a certain value is excluded. Like it's an excluded asset when they're looking at your asset picture for eligibility. So you maintain that when you're on Medicaid. But if she were to gift this house to her daughter, then yeah, that could certainly impact Medicaid, meaning they look at this year over year. Most states do. They'll look at this year over year. They'll look for transactions. And if that house was gifted, because what Medicaid's going to do is that at the end of your life, they're going to tally up, okay, what was your cost of care?
Yeah.
And then they're going to tally that up and say, okay, now we're going to seek to recapture that from what's left over in the estate. In this case, the value of the home. So if you were to gift that house while you're on Medicaid, yeah, it could certainly have some implications on your Medicaid benefits. So I would understand your state's rules around this, making sure you're getting some good advice before you just go ahead and do that, because the last thing you want is just changing the name on the deed of that home at your county recorder's office, all of a sudden just completely wiping out your Medicaid benefits for a period of time. That could have some tragic effects on your overall situation. So, in this case, you want to have a plan in place, and the answer might be, at least from the outside looking in at this point, not knowing the whole picture, especially what state you live in, that probably wouldn't be a good idea.
Yeah, I'm gonna err on the side of caution and say that's probably not what you want to do. I mean, if your ultimate end game though is for the house to go to your daughter, I mean, set that up in your will and trust, but it doesn't necessarily mean that, to your point, if Medicaid is saying, well, we need to recoup these expenses that we have incurred by providing for your care, and they could come after that. Yeah,
and this is what, I mean, I hate to say it, but this type of planning should have been done before Medicaid was really in the picture, right? Like you try to get ahead of this. Ideally you get ahead of this 5 years. Obviously it's hard to have the crystal ball to know exactly when you're going to need that level of care, but that planning should have been done beforehand, because you could have gifted the house to the daughter. You could have put it in an irrevocable trust where you lost control. So then even though it's an excluded asset at application, if you did that type of planning beforehand, then you still get the Medicaid benefits. And then after you pass, if Medicaid goes to look to recapture, well, that home's no longer in your estate. It's in that irrevocable trust, or already in the name of your daughter. So they don't have anything to recuperate.
Yeah. And remember, as Jeremiah said, every state is specific. I should have verified this while you were talking, Jeremiah, but I believe I've looked in at Washington State. I believe they have a 7-year look back.
Yeah.
I mean, each state is nuanced. So really important to do your due diligence and work with an expert within that field within your specific state.
Yeah, we did a show with this with some basically they're in the business of consulting on how to plan for Medicaid for this very reason. We're going to have them back on for a podcast, I think in about 1 or 2 weeks. But if you go to therealmoneypros.com, you can find that archived episode, and they dropped a lot of knowledge on how to properly plan for Medicaid to make sure that not only do you get enrolled, like at what level, but also the protection of your assets, making sure that there could be something left over and it's not subject to recapture. We'll be right back. Phone lines are open, 979-59-MONEY. You can text us as well, 979-596-6639. We are live here for you. You want to change the topic, talk about estate planning, talk about tax efficiencies, talk about QCDs. So we had a question come in around RMDs, and I'll kind of summarize this. 74, I take RMDs every year. I don't need it. Seems like I'm just paying taxes on it. I'm donating money to my church. I heard you guys talking about QCDs a few months back. Am I doing this wrong? Sounds like there's a smarter way to handle this so I can save myself money in taxes. Yeah, absolutely. Yep. So I know there's some terms in there that I think we need to define to the listeners out there, but no, it's a really good question. And like, this is really around how all these moving parts actually hit your tax return. So RMD stands for required minimum distribution. And when you hit a certain age and you have money in a pre-tax account, let's say a traditional IRA, a traditional 401k, a SEP IRA, a simple IRA, when you hit an age, the IRS says you have to take money out. Because remember, you never paid income tax on that from the state or federal level. So when you get to a certain age, the IRS says, well, you have to start taking money out, whether you need it or not, by the way.
That's the big kicker.
And if you don't take it, you're going to be penalized. So, of course, you don't want to just lose that money to a penalty. You're going to take that money out. Now, when you take that RMD out, what actually happens is your IRA or wherever your IRA is held, let's say it's like a Schwab, a Fidelity, you take money out of your IRA, let's say in 2026, you're going to get a 1099-R. That's going to show how much money you took out of your IRA. And let's just say it's $50,000. So that $50,000 distribution out of the IRA, it's going to be in a formal tax document that you're going to put it together with all your other tax documents, and you're going to give it to your tax professional, your CPA. They're going to put that all into the tax calculation, and ultimately that RMD is just going to be taxed as ordinary income. So wherever you're at in the marginal federal tax brackets, wherever you're at for your state income, that's how that RMD is going to be taxed. Now let's add in the charitable side of things. So this text message says, I'm taking my RMD, then I'm taking a chunk of that and I'm donating it to the church. So 501c3. Okay, we don't have the exact numbers of how much they're doing, but yes, you're getting the money to the charity. So let's not lose sight of that. Like the charitable minded, giving money to the charity, you're checking that box. But where you're not, in most cases, you're not recognizing a benefit from a tax standpoint is because standard deductions are so high. For a married couple filing jointly in 2026, the standard deduction is over $32,000. $32,200. And then if you're 65 and older, per the big beautiful bill, you can get an additional $12,000 enhanced standard deduction on that. So $32,200, add another $12,000 of that. Like
$44,200 would be your standard deduction.
So that's your standard deduction. So, you know, if you're self-preparing or your CPA is asking, okay, give me a list of all your itemized deductions. At least in my experience, it's been a bit of a rare bird where those itemizations exceed those standard deductions. So that's likely what this text question, this listener via the text question is saying is like, hey, I'm donating to the church, but I'm not seeing any tax benefit. Well, that's why.
Right, because the standard deduction is so high. But now let's take the case where you said, like, well, what if your RMD is $50,000? I'm not good at math in my head, but $50,000 is a bigger number than $44,200.
Assuming he's doing the whole thing.
Correct, assuming he's doing the whole thing. Now, let's say that in theory, okay, you don't need any of that $50,000 for income. Between Social Security, pensions, maybe some, non-qualified investment accounts, rental property income. Income is not your problem. Just paying taxes is the issue that you're trying to resolve. You could do a qualifying charitable distribution directly from that IRA, and the custodian, Vanguard, Schwab, Fidelity, whoever, because you've instructed them to do a qualified charitable distribution, they are going to mail a check directly to your church, your 501c3 of choice. Because those dollars never land in your personal checking account, but they leave your retirement account, that qualified charitable distribution, it will satisfy the IRS rules that say you have to take out a minimum amount. So it'll satisfy that $50,000 RMD that you're on the hook for, but you're not paying income taxes on that $50,000. Again, because it's a charitable donation, it's a charitable distribution from that IRA. It would exceed your standard deduction in this scenario that we're creating. So you get that tax benefit in this scenario, and the recipient, the charity of your choice, they're receiving that without having to pay any sort of taxes on it because they're a qualifying 501c3. So it is a more efficient vehicle, that qualified charitable distribution. It's a more efficient vehicle, and if you think about it, it's actually putting more of your money that you want to give to charity into the charity's hands, because the flip side is I take the distribution, I incur the federal income tax, I may incur that state income tax. Maybe you combine those two numbers, maybe you're paying 28, 30, 32% in total taxes on that $50,000. You didn't need it, so do you want to give, a net 35 to a charity of choice, or do you want to give a net 50 to a charity or multiple charities of your choice, still satisfying the IRS guidelines that say you have to take out money?
And now how this actually, the rubber hits the road from a tax standpoint, it's really simple. There's updated reporting requirements with custodians. If you do a QCD, there's going to be a box that's checked on that 1099-R. So if you give that 1099-R to your CPA, they're going to see, oh, that was a QCD, a charitable, qualified charitable distribution. Then we can account for that on your tax return. That amount's not even going to touch your gross income. It's it's just not included in your income at all. So like Nick said, much more efficient. And here's the nice thing too, you do not need to wait till you're of RMD age.
Correct.
So like 73, 74 in some cases. You can do qualified charitable distributions from your IRA when you're 70 and a half. Now, to be clear, you need to be 70 and a half and older. It's not the calendar year that you turn 70 and a half. So you got to pay attention to that. And most custodians will actually catch this. They're going to say, oh, wait a minute, you're only 70 in 3 months. Nope, that you don't qualify for that that qualified charitable distribution. So no, 100% to this listener who sent that text question, highly recommend doing the QCDs. It's not a lot of moving parts. It's one of the lowest hanging fruits of tax efficiency that you can utilize. Not a lot of moving parts, easy to execute, and tangible tax savings for something that you're doing anyways.
And there's potentially additional benefits or opportunities that are created. So you're doing this large QCD. Maybe it's bringing you back down on your Medicare Part B premiums because your overall income is being lowered by that. Maybe you're not so worried about your Medicare Part B premiums, but you're saying, do Roth conversions make sense for me? If I can do a large QCD with this, it frees up room within those marginal tax brackets to do an additional Roth conversion. And kind of like your net taxation now is the same as it would be, but you've done this charitable distribution and you can do a Roth conversion. So there's layers of opportunity that can be created through qualified charitable distributions.
Well, and on the Roth conversion part of this strategy is that, if you're doing these Roth conversions, then in theory you're reducing the dollar amount in your traditional IRA, which would then translate into lower RMDs in the future.
In the following calendar year.
This whole thing kind of comes together and how these things coordinate with each other to help the overall plan. And I think that's very common where these types of these types of strategies are almost looked at like in a vacuum on their own. But you can see it, well, okay, there's that tax savings with that QCD on its own, but Well, look at what we can do with the Roth conversion. Maybe we can do this with a taxable gain. Maybe now we're getting into this this enhanced standard deduction because your income's lower, and then the IRMA charges with Medicare, and what else is on top of that. So, again, it's kind of along this adage of this comprehensive plan, and I don't know the exact definition of comprehensive off the top of my head, but meaning it's zoomed out. It's looking at the entirety of your picture. Who's helping you make these financial decisions? The right guidance matters. Again, visit therealmoneypros.com, click on Find an Advisor tab. We can connect you with a fiduciary advisor who's a good fit for your situation. You've probably been thinking about this. Ideas are great, but good quality action is even better. We'll be back next weekend.